Maybe Trade War 2.0 wasn't priced in after all. 30 minutes until the start of trading, I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
And coming up, after weeks of threats, President Trump makes good on his pledge to impose tariffs on Canada, Mexico, and China. And now he says Europe may be next. That move threatening to hobble the U.S. economy and push up prices for consumers. Businesses and investors bracing for that fallout. And Wall Street weighing in as well. Goldman says there's a risk of a 5% slump in U.S. stocks, while RBC puts that range at 5 to 10%. We'll hear from Citi's Stuart Kaiser in just a moment, but let's take a look at these markets. 30 minutes until the bell, you can see we have a down day when it comes to the U.S. equity market. The S&P 500 off about 1.6% at the moment. Big tech even more, really leading this move lower, which is interesting here. And we're taking a look at the cross-asset action right now, because you take a look at oil really screaming higher right now, up almost 3% on NYMEX crude oil. A lot of concern about tariffs on Canada and what that will mean for the U.S. energy picture. You can see that being expressed in oil prices right now, and the dollar as well, really strengthening here as investors question what this will mean for the Federal Reserve. You can see the Bloomberg Dollar Index currently up about 0.7%. That's not even session highs, Sonali.
It's incredible. Moves across assets, moves across sectors as well. We're taking a look at the auto sector. Stocks are down there. The incoming tariffs will heavily impact the sector, potentially raising the price of cars in the U.S. by $3,000, according to one estimate. General Motors now down more than 7% pre-market. Ford and Tesla also lower. But then there's the energy sector. The tariffs threaten flows from two of America's biggest foreign suppliers, Canada and Mexico, which send about 4.5 million barrels a day to the United States. You're seeing the biggest drop here in Vistra, of course, which has been a darling throughout the course of the last year. NRG also down, each down 5% for Vistra, but Constellation only down about 3.6% pre-market. Also looking at Constellation brands, because more than 80% of beer imported in the U.S. comes from Mexico, and you're seeing the impact here mostly in Constellation, 5.6% lower pre-market, but you're also seeing Molson and Diageo down pre-market. Just everywhere you look, Katie, you're seeing an impact.
Absolutely, and you add it all together, you're seeing that pain at the index level, and you have to wonder at what point this will catch Donald Trump's attention. Of course, we know that he cares about the stock market, but maybe a little bit less than he did in his first term. You have a note out from Neil Dutta over the weekend talking about how the strike price on the Trump put is a lot lower than maybe we thought it was. And Matt Maley also out this morning saying that President Trump does not fear a correction in the stock market. So we'll see, of course, what kind of moves we need to see to prompt a response, and also whether or not these tariffs will even go into effect.
Well, to that end, holding out for that last minute deal. Investors are certainly hoping for one. Interestingly enough, you see the VIX less than 20, right below a 20 handle. We're going to talk about that more in just a minute with Stuart Kaiser over at Citigroup. But before that, of course, we're going to bring in our own Emery Hordern, co-host of Bloomberg Surveillance, and has been following this very closely. You know, this whole idea of what will be impacted. I thought there was a really interesting discussion this morning you had with Amrita Sen, I believe, about just how much U.S. energy is going to be hit.
Yeah, it's 4.5 million barrels a day coming, more than 4 million of that coming from Canada. Implicit in what Trump is talking about, only putting 10% tariffs on the Canadian crude imports. Clearly, the administration is aware of how critical the Canadian crude, that heavy, usually sour crude, is to these landlocked countries in the Midwest. Some refiners are literally only built to deal with this Canadian crude. But still, there's going to be a 25% tariff on the more than 400,000 barrels that come from Mexico. So that is going to take a hit. We already know that traders are looking at where they can get this type of crude elsewhere, because we don't have it, or a lot of it, in the United States. You'll have to go to Brazil, maybe places like even as far as Iraq. So there is going to potentially be a rerouting of crude trade flows. This is just one aspect of these broad-based tariffs. We should note they aren't in effect yet. They will be in effect after midnight. But there is a call that'll be happening this morning, or two calls, between Trump and the president of Mexico and the prime minister of Canada.
Well, that's exactly where I wanted to go. What the next couple hours before a minute after midnight on Tuesday looks like. You mentioned these calls are going to happen, and some people have pointed to the fact that you do have that conversation, that dialogue, as a reason why this has been a pretty orderly move so far in terms of a sell-off. How big is the chance, are people telling you, that actually they don't go into effect, these tariffs?
Well, I'm not sure if there's a chance today, but I do think that there is a chance that Trump is in negotiating mode. He clearly wants something from Canada and Mexico. He's made it implicitly clear. He feels like he's won this election on immigration. He wants to go after illegal immigration. He wants to go after the flows of fentanyl. There's more than 40 pounds of fentanyl that came into the United States of the northern border in 2024, according to the data, and then literally thousands coming in when it comes to southern border. And you can see they're using these tariffs through IEEPA, saying it's a national security concern. So potentially they could be short-lived. The big question going into this call is what constitutes success that Canada or Mexico can either do to unwind this threat. And at the moment, that has not been clear.
Yeah, what is the goal here that these tariffs are working towards? Anne-Marie, stay close. That is Bloomberg's Anne-Marie Hordern. And let's continue this conversation now with Citi Head of U.S. Equity Trading Strategy, Stuart Kaiser, joining us at the desk. Another manic Monday trading session to talk to you. And I want to talk about what this move represents to you, because there's plenty of people saying that, okay, maybe tariffs weren't priced in, that these threats would actually turn into policy. And then you have sort of the zoom out crowd saying, actually, this is kind of a muted, orderly move. How are you reading the pre-market price action? Yeah,
I think it has been pretty orderly. I mean, since the highs on Friday, we're down, call it, what, 2.5%, 3%, which is not trivial, but, you know, it hasn't been a kind of run for the hills type moment. As Sonali mentioned, the VIX hasn't really, accelerated higher the way it did, let's say, back in August when you had real positioning risks and real kind of surprise in the market. So, I mean, if you're an investor in these U.S. equity markets, you didn't have tariffs on your list of number one risks, early in the year, then clearly you weren't paying attention. So I think part of the reason it's been orderly is because people have their lists. These are the stocks that import from Canada. These are the ones from Mexico, et cetera. So I think investors are pretty well prepared for this. But, anytime you're looking at these risks, it's a risk-adjusted kind of distribution of outcomes. And you had something like 25% tariffs, which was not your base case, which looks like it may get implemented. And the market's reacting to that accordingly.
When you look at the groups of baskets that investors are looking at right now and trading through, what is not yet pricing in some of the worst that is to come or could come?
Yeah, well, I mean, what is the worst? I think is the other issue. I mean, Canada was, I think, not viewed as a target of tariffs originally. So, that's something where people had to kind of sharpen their pencils again. I think people really, people were trading the peso and Mexican companies more directly on this. So I think the Canada stuff is a little bit of new news. The big kind of unknown, I think, is what happens with Europe. And, to the extent that he wants to tariff Europe, that becomes a bigger and more significant, I think, kind of issue. So if there is a risk that is not priced, it's probably Europe. And that's basically because it hasn't been talked about yet. So I think Europe is kind of the next one up for people to deal with.
Yeah, and you can see all that being expressed in the currency market. The loonie weakening against the dollar right now to the tune of about 0.9%. A lot of people have euro parity on their mind. But I want to bring this conversation back to the stock market and the idea of that Trump put, because sort of the cushioning for the bulls has been that Donald Trump cares about the stock market. But this time around, people are saying maybe he cares a little bit less. At what point do you think this indigestion that we're seeing would actually catch the president's attention?
I mean, I think you need a move much larger than we've had. I mean, you were basically at all-time highs on Friday, and now you've pulled back a couple of percent. And there's also bogeymen he can blame that aren't himself, right? I mean, you can blame China, you can blame AI and other things like that. So I think you need a significant move lower to deal with this. And look, a lot of the logical also probably would be, look, we can take some short-term pain in the equity market if we deal with long-term, trade imbalances that we've been, in his view, kind of suffering for decades. So I do think, the Trump puts a little bit lower. What's kind of interesting to me is folks that have such high conviction that they know what he's going to do. I think if you're an equity investor, I think anything's on the table, and you can't assume. I mean, I would not be assuming that this is a short-term disruption, nor would I be assuming that I know what he's going to do at midnight, much less next week. So I think you need to be very nimble in these markets.
Yeah. Speaking of what's priced in, if you think about what might be priced in terms of what the president of the United States is doing, what about retaliatory tariffs? Do you think investors have really priced in what's possible and how the world might react?
I would say no. I mean, that's your big risk from a tariff perspective. I think the base case for most investors was something that looked like about 10% across the board tariffs, obviously with moving parts around that. But the retaliatory aspect, I think, is the part that will probably gets the Fed's attention as well. Modest tariffs without retaliation, I think the Fed would view as just sort of a one-time impulse on prices. If you start to get a full-on trade war, that becomes, something much more difficult and something just much more complicated to handicap. So I don't think that risk is fully reflected. And again, it is a known risk. It just happens to be active right now.
So, Stuart, what's the hedge against these geopolitical tensions, these tariff risks? Because I take a look at the bond market, not really doing much here. I take a look at gold. It's up a little bit. Where do you seek shelter in this market?
Yeah, I think gold has been a very popular one. It hasn't moved a lot today, but last week you did have a significant move higher in gold. I think, honestly, it's a little more nuanced than probably at the asset or index level. People are trying to identify specific U.S. stocks, specific U.S. industries and things like that to kind of hedge that. But look, I think if you believe in tariffs, what you believe is Donald Trump is prioritizing domestically facing and sort of more cyclical companies. So you kind of want to stay away from those kind of large international exporters. But I think you really need to do that, stock by stock. It's not something that you can kind of cleanly do at the index.
Well, because small caps, they were sort of pitched to do well in that environment. And yet you look today and the Russell 2000 just falling out of bed.
Yeah, well, Russell 2000 has had a tough 6 to 12 months.
Don't we know it?
Stuart, stick with us. That is Citigroup's Stuart Kaiser. Of course, we're going to talk more about those small caps and the rest of earnings season next. We're going to dive into the earnings week ahead with Stuart. Stick with us. This is Bloomberg. And now to high interest, a look at what's making headlines around the world. Panama is promising free passage for U.S. warships through the Panama Canal. That after Secretary of State Marco Rubio met with the president over the weekend. President Trump complained about what he called exorbitant rates that he said Panama charged for using the canal and threatened to retake control. And Elon Musk is mapping out his team's plans to make aggressive cuts to U.S. spending and regulations. This includes wiping out the U.S. Agency for International Development and shutting down some payments to federal contractors. There are concerns about the extent of Musk's access and the potential for abuse. And Beyoncé took home the Album of the Year award for Cowboy Carter at the Grammys last night, although she has won the most Grammys of any artist in history. This was the first time she had gotten the top prize. She had won the award for the Best Country Album, the first time a black artist has won in that category, Katie.
Beyonce, if you're watching, congratulations on the Grammy, but we have to check these markets right now because we do have a sell-off underway and then some. The S&P 500 down about 1.6%. That's actually not session lows. We were at deeper losses in the overnight session, coming back a little bit. Same story if you take a look at the NASDAQ 100, down about 1.8% on your big tech index, but it's really the small caps bearing the brunt of this sell-off, even though a lot of these smaller companies have more of a domestic focus, aren't as exposed maybe to that tariff story as those big internationally exposed companies. Still, the Russell 2000 off by about 2.2%, Sonali.
And we're going to be back now. Citigroup's head of equity trading strategy, Stuart Kaiser, with us here on set still. We were talking about this in the commercial break, this whole idea that just a week ago, you had a market that was really rattled by that DeepSeek issue, this idea that maybe we don't need as much CapEx for AI spending in this economy. When you think about the fragility of big tech and you think about the fragility of this tariff threat that is being created in the market, what's the upside here? There's still mostly analysts across the street thinking we're going to get much higher this year, but how much pain do you endure in between?
Well, I think from the AI perspective, it was actually pretty encouraging last week to some degree in the sense that, yes, NVIDIA and some of the semi stocks sold off, but, the majority S&P stock was up on the day. And I think what people said is AI is still a very important investable theme. I'm just going to go at it a little differently, right? I'm going to approach it from the software AI angle or kind of do a little bit of an end around. If you wanted to take the bull case from AI, it would be fine. 3 or 8 or 10 stocks got hurt really bad, but for the rest of the market, AI just got faster to develop and cheaper. So that I think is a kind of net positive on the AI side. For the equity side, look, you need the good things that were forecast to happen, and part of that is earnings. You have about 14 to 15% EPS growth forecast in. You have a Fed that wants to cut, and you have strong U.S. economic growth. So I think the bull case metrics are still there. The problem is you have very high valuation and a pretty skittish market right now.
Well, let's wrap in tariffs with the earnings picture a little bit more closely here, because you have Goldman out this morning saying that David Kostin, he's saying that he would reduce his S&P 500 earnings forecast by about 2 to 3% if these tariffs were sustained. You see something similar coming out of RBC saying to expect maybe a 5 to 10% drawdown as it relates to the earnings and tariffs picture. What's your view at this juncture, given all the known unknowns right now?
I think, look, if the tariffs as they stand, the market is telling you this is probably like a 3 to 5%, type issue for the market. We'll obviously have to see, we discussed earlier about whether you get retaliatory and stuff like that could kind of cascade it through. On earnings, it looks like the impact will be relatively modest. But again, we don't know the length of the tariffs or the size or which countries are going to be applied to. So, I think kind of putting a specific number on it is very difficult. But yeah, I think the markets are telling you this is a 3 to 5% type issue unless we get like a full retaliatory trade war cycle.
And we do have some news here. Trump, of course, making some comments saying that he just spoke to Canada's Justin Trudeau and that he will speak to Trudeau again at 3 p.m. So a lot of headlines to keep an eye on over the course of the day. But sticking with earnings, what do you make of what we've seen so far? Of course, we've had two big sort of upsets thrown in from DeepSeek to now tariffs. But if you take a look at the beat rate, it seems a little bit less impressive than what we've seen in recent quarters past. Yeah,
I think it's kind of been a tale of two seasons to begin with. After the banks reported, you had a nice about 150 basis point, uplift in quarterly EPS estimates. Post-tech, a little bit of that came out. Same for the beat rate. The beat rate was doing pretty well until last week, and it kind of came off. But if you take a step back, the consensus for the quarter is up about 0.5%. Not great, but not horrible. The average stock is rising on earnings. The average stock is kind of beating its earnings implied move. So what does that tell you? You've had a pretty volatile but net modestly positive earnings quarter. Obviously, the market has rewarded that. Since before banks reported, equities were up, until last night. So, altogether, I think it's been a decent earnings quarter. You've had consensus revised up. You've had the average stock rise. The S&P has kind of trailed that. But, it's also revealed the risk that these earnings are a high bar.
Yeah, when we think about the risk, too, I also want to pull up what it looked like underneath the hood of the Mag 7 over the past month. The dispersion is incredible. You had Meta accounting for a bulk of the gains, and you did have three of the stocks in the Mag 7 down, Microsoft, Apple, and Nvidia, over the course of January. Mm-hmm. What does that mean in terms of the investor setup as we finish off big tech earnings?
Well, I think what it tells you is the bar is high even for Mag 7, and investors are really kind of going into each earnings season saying even within that small group of stocks, there's 2 or 3 that I'm comfortable with, and there's 2 or 3 that I kind of see.
Meta, and more Meta.
Yeah, and look, and Meta's on the software side of things. So I think what the market is telling you is that is the micro version of what I mentioned, that people are a little concerned with the semis trade, but still believe in AI at large. And for that reason, they need to find a place to put that money. I mean, we've definitely seen retail support for NVIDIA on the sell-off. I think we've seen continued institutional supply. And what I think that tells you is Wall Street is a little concerned about the semis trade and is for looking for other ways to access AI as a theme.
How crowded then, after some of these sell-offs, are some of these trades still, particularly when it comes to AI?
I'm very crowded. I think they still are. You don't undo 2 years of positioning in a week of trading. And I think that applied last summer for the yen carry trade. I think it applies for large cap U.S. growth stocks, and it definitely applies for Mag 7. If you're a growth investor, a U.S. equity investor, frankly, a global equity investor, these are the stocks you've been buying for 12 or 24 months, if not more. To rebase that positioning in a week, you would have had to have been down significantly more than we were last week, in our view.
Yeah, absolutely. And we'll hear from Natalia Konijevich a little bit later in the show, but you take a look at some of the positioning data. You do have hedge funds dumping U.S. equities for a 5th straight week. At least a good time trade for some of those hedge funds. But before we let you go, I do want to meditate a little bit more on the small caps, of course. You take a look at the Russell 2000, really been going through it over the past few months. And again, the bull case, or at least part of it, was that these tariffs were going to benefit these domestically focused companies. What nuances would you add to that narrative?
Well, I think if you think from a macro perspective, you have kind of your hard landing recession outcome. You've got like the immaculate soft landing, and then you would have what I would call higher for longer, which is kind of modest growth where rate cuts get pushed out. only in one of those three, which is the soft landing narrative, do small caps really perform the best. So I think what you're seeing on small cap is it only really works in sort of a narrow corridor of data outcomes, and that has become, just a big headwind for it. I think, look, the move higher in yields initially helped small cap and value, and then people realized that no, these companies actually carry more debt, need to refinance, have a little more credit risk. So I think what you're seeing is you really need to thread a needle to get the small cap trade to work, and we've been able to thread that needle for narrow periods of time. And then lastly, who's the incremental buyer of small cap? I think is an issue. You do have institutional money will go into small cap tactically ahead of key data, ahead of key headlines. But retail doesn't tend to buy small cap, and I think that makes that trade have a little bit less follow through, than some of the other stories. If you're an investor in Europe or Asia, you're not buying U.S. equities to buy a low quality cyclical, right? You're coming here for large cap growth, and I think that lack of a second buyer has hurt.
But don't rule out the equal weight. I missed you last week because the Russell might have underperformed, but the S&P equal weight really held its own.
That's true. So people, looking to get outside that concentration, maybe not in small caps, but still equal weight. Seeing some sunshine. Stuart, great to see you, though. Really appreciate your perspective this morning. That is Citi Head of U.S. Equity Trading Strategy, Stuart Kaiser. Now, coming up next hour, more on the trade war and economy with former White House economist Joe Lavorgna. This is Bloomberg. All right, welcome back to Open Interest. On the first trading day of February, a lot of people probably wishing that this stock market just doesn't open at all, because you take a look at the early morning action, the S&P 500 currently off by about 1.7%. Not the worst levels that we saw overnight, but still pretty bad. The Nasdaq 100 down about 1.9%. And then the Russell 2000 off by about 2% right now. The small caps really feeling the brunt of that pain. So big moves, pretty orderly. You could make that case, of course, if you're feeling a little bit optimistic, but we'll have to see how this market opens in less than 4 minutes. We'll discuss, of course, all of that action with Dana Dioria of Envestnet. That conversation up next. This is Bloomberg. All right, we are moments away from the opening bell on the first trading day of February. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. A pretty brutal start, of course, to the month. You think about just a week ago, we were dealing with DeepSeek AI and what that meant for the AI build-out supply chain. Now we're dealing with the broader supply chain and, of course, the threat of tariffs going into effect at 12:01 a.m. on Tuesday when it comes to Canada and Mexico and China. You can see the action in the pre-market right now. Traders trying to price in the fact that maybe these weren't threats. Maybe actually these will turn into policies. Of course, the questions become how sustainable they will be, how long-lasting they will be, and what that means for the Federal Reserve. But even still, you can see the opening bells are ringing. People are clapping over at the New York Stock Exchange, over at the NASDAQ as trading does get underway officially. And you take a look at how we open 27 seconds in. You can see the S&P 500 off by about 1.7%. And then it just gets worse from there. You can see the Nasdaq 100 off by about 1.9%. Big tech really feeling the pain here, but even that pales in comparison to what we're seeing in the small caps right now. The Russell 2000 off by about 2.4%. For all of these indexes, last week was a down week. This week kicking off on a down note as well. And it'll be interesting to see if the earnings picture changes anything, but we have to start, of course, with the automakers. When you think about the impact of tariffs, half of U.S. imports of assembled cars come from Mexico and from Canada, with some 80% of car parts imported in the U.S. coming from those two countries as well. There's estimates that car prices could jump by $3,000, according to Wolfe research. And as such, you take a look at the big automakers this morning, Sonali, all three lower right now.
And many of them had idiosyncratic issues of their own. This really adds to the storm. I'm looking at the booze companies here. Constellation Brands, Molson Coors, Diageo. Of course, input prices will be higher. The U.S. imports 11.8 nearly $8 billion of mainly beer and tequila. More than 80% of the beer imported into the U.S. is from Mexico. Tariffs could push consumers to more domestic booze companies. Constellation feeling the brunt of the pain, now down more than 7% as the market opens. We're going to check on the energy sector as well. Canada and Mexico are two of the largest external suppliers of oil to the United States. Trump signed a levy of 10% imports on Canadian energy, sparing it from the 25% benchmark, but still pretty brutal. We're looking at different forms of energy companies here. Vistra also down now almost 5% as the market opens. NRG and Constellation also dropping, as well as the traditional oil companies as well. We're looking at the tech sector this week as well, because they're heavily relying on all types of this energy to power AI. We're going to get some major earnings like Google and AMD this week. We're going to discuss it with Bloomberg Technology's Caroline Hyde. We were talking a little bit about how the Magnificent Seven over the past week, major dispersion. And when you think about the week ahead, what are you listening for?
Again, it's going to be about capital expenditure. Again, it's going to be about the thesis of where value is going to accrue from generative AI. What is AMD going to be doing in terms of managing to steal away some of the server and data center revenue upside that NVIDIA has so dominated? AMD is going to be coming out for us. We've got the who's who coming out throughout the few days. You've got the likes of Qualcomm, another chip sector, another car-orientated company. So keep an eye on Qualcomm and what they say. We're going to have Uber as well coming out a little bit on Wednesday. But on Thursday, you're then going to be getting into the nuts and bolts of what Amazon is saying. Alphabet, of course, is coming on Tuesday night as well. And more imminently, tonight we've got Palantir. Now that is a generative AI story, Katie.
Absolutely. And tell us about the expectations there, because as I mentioned at the opening, we're just a week out from those initial DeepSeek AI headlines that really rattled all of Silicon Valley and Wall Street as well. When you think about Palantir coming up, you think about what we heard from some of the tech giants last week. What are the expectations, and have they changed at all relative to a week ago?
Expectations for Palantir are so extraordinary in terms of what is priced in and what they could ever deliver to vindicate a more than 200 times price to future earnings currently valuation, that they've got to start to show that the hype is real, that you're going to see government continue to plow into their offerings when you've got a competitive threat like China. Now, interestingly, Dr. Karp was speaking out about what we saw with DataSeek and how important it is for the US to compete and ramp up in terms of spending on generative AI. But this is a company that's going to give us about a 28% uptick in revenue. You're likely to see earnings actually come worse than the previous year. 28% revenue when you're delivering, in terms of a stock run up of 350% in the last year. How are they going to vindicate that? Brent Thill, of course, over at Jefferies, has said the only way you could substantiate this sort of market capitalization, this price to future earnings of 200 times, you're going to have accelerated growth of 50% over the next 4 years. They're going to deliver us 28% growth. So many are going to be worrying about a slowdown in Europe in particular, and indeed whether or not we're just seeing the generative AI hype be realistic to what really retail have driven into a frenzy in terms of their stock last year.
Absolutely. The stock up 370% over the past year alone. Certainly the stakes are high. Bloomberg's Caroline Hyde. You can catch her on Bloomberg Technology right after this show. But stick with us, because joining us now is Envestnet president and co-CIO Dana Dioria. She joins us now. And Dana, I have a very interested viewer writing in. His name is Matt Miller. Usually he's at this desk, but he's somewhere in Indonesia, I believe. But he writes in that he can't believe the market is holding up so well. You'd think oil would be at least 80 plus and treasuries 30 basis points higher in terms of yields. You think about what we learned over the weekend when it comes to tariffs, that deadline ticking down to tonight at midnight. Do you think that this is a reasonable reaction in the markets, or would you have expected to see a little bit more fireworks?
Well, we're just starting, right? We'll see how the course of the day goes. So this is one of those moments where it's difficult to say. We could have a pretty bad day in the markets today. What I will say is a couple things. One, obviously, to a certain extent, the market had priced this in, or at least the possibility of it. I think the Trump administration demonstrated within the first few days that much of what they talked about doing, they were going to do, right? And so all these executive orders that you saw happen literally first days of Trump's presidency. So I think to a certain extent the market was already anticipating some of this. I think it's not surprising where you're seeing some of the biggest impacts. So you look at small caps. I think over time, as the market digests the actual impacts, and small caps are not potentially as affected necessarily in tariffs because they don't have as much international dependency. But what they are impacted by is interest rates. And the Fed will undoubtedly see this as inflationary. So we're probably looking at higher for longer, which is not good for small caps. So I think the immediate reaction is sort of what you'd expect. But there's a lot to go here for the market to piece together what exactly this is going to mean. And of course, there's more news to come, right? We already know that he's looking at Europe as well.
And not to mention the current set of tariffs are expected to take effect midnight into tomorrow, but a lot can happen between now and then. And even beyond that, we were talking to Stuart Kaiser over at Citigroup a little earlier. The point he made is even if you have some of the tariff threats from the president of the United States baked in, what you don't necessarily have, and want to see if you agree with this, is the idea of retaliatory tariffs. If we have other nations, Canada, Mexico, otherwise reacting, do you think some of that threat is priced into the market right now?
Well, I think the market certainly has understood that there's going to be a reaction, that retaliatory tariffs are, likely. I think it's interesting that Trump did 25 for Canada and Mexico and only 10 for China. If you look at just revenue from the S&P, China is a bigger piece, right, than Canada and Mexico. So I think there's, a consideration that that's going to happen. And I think to a certain extent, the market is, again, piecing together how much that can impact. The immediate obvious effect, inflation, prices of goods increasing and therefore interest rates staying higher. The longer term effect, you have to also consider, is this where we land, right? And I think you're sort of suggesting that to a certain extent that this is an administration that approaches a lot via a negotiation stance. So is this a starting point? And then, there's some negotiation and maybe, we ease off a little bit. That remains to be seen. But to the extent that there's retaliation, obviously, if there is no negotiation here, if we're at 25, they retaliate, Trump makes good on the threat to go even further, things could get pretty drastic.
Well, given that there's so much we don't know if these tariffs will go into effect. And if we do, we don't know if there will be retaliatory tariffs. How do you position around this? It feels like you can't escape it at the benchmark level. So do you just look through what we're seeing right now, or do you look for hedges here?
So I think if you're in the markets, this is classic systemic risk, right? It's hard to find a place in the market that's not going to be impacted by this. There's, of course, systematic risk which is across the board risk. And whether you're in the U.S. or overseas, whether it's international, developed or emerging economies, this sort of global trade war type of a consideration is going to impact across the board. Now, how much it impacts different places will certainly matter. But most retail investors are sitting in some sort of maybe some tracking error to it, but something that looks akin to maybe an S&P 500 investment or an MSCI ACWI. And so for them, the systematic risk is going to impact all of equities. And that's why you're seeing gold stand up. How are bonds going to react to this? The typical place for retail investors is to look at what is my risk tolerance for all of this, and do I have more than I need in equity markets in general? But I would caution anybody to try to, move on this, right? You don't know where it's going to land. I mean, we saw pre-election night that Mexico looked like it would be a beneficiary because a lot of the talk was around China. So trying to find sectors at this point, say I'm going to hide out here, or countries or geographies, I think is a tough situation to be. It's more, am I overly exposed in equity markets in general?
Dana, we thank you so much for your time today. I wish we could go longer. As you're speaking of gold, you have gold hitting another record. It's certainly the haven trade of the day. That is Envestnet's Dana Doria. Thank you. Now we're going to hone in on one sector in particular, the auto sector, because markets are digesting Trump's tariffs, and that's a place you could seriously see it. Stick with us. This is Bloomberg.
All right, it's time now for Top Calls. Some of the analyst action in focus this morning. Tariffs, obviously a big theme today. And first up, Loop Capital downgrading transportation companies, including FedEx, citing President Trump's tariffs. The firm has, quote, eliminated all positive ratings in the sector and recommends clients don't add to positions until the dust settles. You can see the dust not settled right now. FedEx shares currently off by about 5.8%. Next up, Piper Sandler cutting its price target and downgrading Constellation Brands, which is the distributor of Corona and Modelo beer. The analyst says that Trump's tariffs could put pressure on revenue. You can see Constellation down about 5%. And finally, U.S. Steel also getting downgraded over at Morgan Stanley, this time because of valuation. However, the analyst does say that steel prices could improve thanks to those protectionist trade measures that have been promised by Trump, but adds that demand growth will remain sluggish. Shares deciding what to do right now. U.S. Steel currently higher by about 0.7%, Sonali.
Now, Katie, I also want to bring you some breaking news because you have Treasury Secretary Scott Bessent is temporarily tapped to lead the Consumer Financial Protection Bureau in addition to his role as Treasury Secretary. This comes after President Trump had ousted the previous CFPB director, that is Rohit Chopra. Remember, Rohit Chopra was extremely aggressive, criticized as aggressive, rather, in his role as the CFPB head. The director of the CFPB, remember, the CFPB was right after the 2008 financial crisis, a very significant body that has in recent months and years garnered more criticism. But of course, a big role here for Scott Bessent to be overseeing this in addition to his existing role,
two things there.
I mean, very large to begin with.
You think about where we were even a month ago, all that optimism that we were going to see a friendlier regulatory environment. This move would certainly signal that shift. But to your point, being Treasury Secretary, already a big job. Scott Bessent going to be a busy man.
Certainly one to watch this week and in the future as well. He's working on debt issuance as well. We'll talk more about that later. We're going to go back. We're going to go talk about the Trump tariffs because, of course, this morning has been a busy one. They will impact $250 billion of trade in the auto sector. And car prices in the U.S. could climb by $3,000, according to Wolfe research. Some 80% of auto parts imported in the U.S. come from Mexico and Canada. We're going to bring in now Bloomberg's Global Autos editor, Craig Trudell. You're really seeing a significant hit to the stocks of a lot of automakers, both in the U.S. and abroad at this juncture. What is the biggest curveball for investors at this juncture?
Yeah, I think even just up to the end of last week, you had some analysts sort of, throwing out there the prospect of, well, maybe there will be an exclusion for autos. I don't think anybody thought this could possibly sort of come to pass, just given how sort of interconnected this industry is. And when you have, in some cases, a part that goes into vehicles at the extreme will cross the U.S. Borders with Canada or Mexico as many as 8 times. And so, when you think about the opportunities for duties, depending on how they're implemented, to really just, kind of spiral and have a really substantial impact on end costs for the consumer. And of course, this is a very low margin industry. The idea of a 25% tariff would just wipe out everybody in terms of any sort of profit margin that is embedded within a parts supplier's relationship with an end manufacturer. And so this would be hugely disruptive to this industry.
Absolutely. I mean, there's some estimates out there that car prices could increase by $3,000 with these tariffs hitting the auto sector. But Craig, I mean, we've talked to a lot of people at a broader level saying, wait a second, just breathe. We don't know if these tariffs are going to go into effect or not. We don't know how long lasting they will be. When it comes to the auto sector in particular, though, when you think about how exposed it is to these tariffs, is there any part of this story that's being overblown at this point?
I mean, I think you have to kind of sell and wait for a reason, wait for an excuse to buy at this point. Especially this 25%. I mean, it's just a really, really substantial. I think it would have been a sort of shock to the system to have, 2.5%. Again, going back to just, the sort of amount of margin that you see within this industry. Even that would be a really big deal for these manufacturers and their supply chain. 25% is just substantial. And so, even a company like Tesla that, has talked about building a plant in Mexico, has not gone through with that. It is sort of widely thought of as being, highly reliant on not just U.S. production, but a U.S. concentrated supply chain. They have quite a bit of parts suppliers, in Mexico and source components from all over North America. And so this, would be disruptive to them as well, which you heard the CFO talk about last week during their earnings call.
All right, sell and wait, not necessarily investment advice there from Craig Trudell. He leads our global autos coverage. Very busy man. And speaking of busy people, coming up, Elon Musk says that his Doge team is shutting down payments to federal contractors after likely gaining access to sensitive Treasury Department systems. That's next in our Wall Street Beat. This is Bloomberg.
And it's time now for the Wall Street Beat. Treasury Secretary Scott Bessent has reportedly granted Elon Musk's Department of Government Efficiency unprecedented access to Treasury systems that process tens of billions of dollars a day in payments for U.S. government agencies. It's all part of a directive by President Trump to modernize federal IT, and Musk's first target is the U.S. Agency for International Development. Bloomberg's Mac Chafkin covers all things Elon Musk. He joins us now. What does it mean for Musk to get this sort of access, especially when it's been so unclear for months now or weeks now what role he would really be playing in the government and where this agency would fall?
I mean, first of all, I think it's clear that Musk's role goes far beyond IT, which is what, as you said, the executive order said. But it seems clear that Musk and President Trump view him as having a role that's much broader, essentially cutting off federal funds to all sorts of parts of the sort of government apparatus, as well as, essentially creating very difficult conditions for civil servants and federal employees under the auspices of reforming the civil service and cutting costs. I mean, right now, it's all about cost cutting. I don't think we're seeing a ton of anything else.
Yeah, and I mean, you make a good point that, again, originally what Doge was envisioned as, it seems like we're past that point. But what has the reaction from Donald Trump been like so far? I mean, we heard from him on Sunday.
Donald Trump has been supportive so far. And it sort of makes sense, partly because, of course, Elon Musk was a major donor to the Trump campaign, the biggest donor, in fact. He's a senior advisor to President Trump. He's in the Oval Office all the time. He has an office in the White House. So of course, they're kind of on the same page. But also, Trump has kind of embraced this method, and it feels Trumpian in a sense. It's chaos. It's the same kind of sort of shock and awe thing that we're seeing on the tariff side, but playing out on the attempts to reform government.
But what's interesting to me too is you don't have kind of Elon Musk hiding behind the decision making and what's happening here. He took to X to have a Spaces session. He tried to answer some questions, but how much of it is actually happening? He said he was going to be talking to Jamie Dimon.
That caught my eye.
That caught my eye as well, because at what degree do you have Elon Musk being able to control the bond market? Of course, this is of critical significance here when you have the Treasury Secretary already reportedly giving him access, thinking about how he's going to deal with the bond market in and of himself. What role then does Musk really have kind of with the broader financial community as he gets this done?
Well, I think Musk is going to do his best to try to make sure that these actions don't hurt President Trump's poll numbers and they don't hurt, the markets. And I think that's going to be a pretty tall order. I mean, we are in pretty uncharted territory here, both because of the sort of questionable sort of legal issues around this. It's not clear that as Musk said, he shut down USAID or shutting it down. It's not clear that that's legal. And I think there would be big questions if that were somebody else in Donald Trump's administration, somebody who perhaps was a cabinet member or who had gone through the vetting process, who had done financial disclosures. But none of that's the case with Elon Musk. It's not totally clear what his status is even within the government. You have these actions being carried out by this kind of small crew of very young people who seem to be loyal to Elon Musk, but again, not clear if they're official government employees or whatever. And of course, Musk is famously erratic. So there are all these potential issues that I think are going to be rattling both markets and voters, in fact, as we go forward.
Well, we'll look to you for our answers. That is, of course, Bloomberg's Max Chafkin covering all things Elon Musk. And coming up in the next hour, we're going to get more on the trade war and the economy with former White House chief economist Joe Lavorgna. That conversation coming up next. This is Bloomberg. All right, we are 30 minutes into the first trading day of February. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
I'm Sonali Basak. Matt Miller is off today.
And he's missing a pretty erratic market right now, a sell-off underway, of course, as markets digest tariffs. You can see the S&P 500 down about 1.7%. Crude and the dollar higher right now. We also have some economic data to chew on, and that comes in the form of ISM manufacturing for January, coming in at 50.9. Survey had been looking for 50 even, and the prior reading was 49.3. You take a look at ISM prices paid, because last time we got that figure, it was pretty dramatic, but ISM prices paid coming in for January at 54.9. The prior reading had been for 52.5. Let's get right now to Bloomberg's chief international economics and policy correspondent, Michael McKee. He's sitting to my left. What is your first blush reading of these ISM figures when you overlay them with the threat of tariffs?
Well, this is the first time in about 2 years that we've had a positive ISM, so that is good news for the overall economy. New orders come in at 55.1, up from 52.1, and production up to 52.5 from 49.9. So it looks like the outlook for manufacturing has improved. Employment at 50.3 is strong, strongest it's been in some time, and that suggests maybe we see some good news on Friday. Prices paid goes up, though, 54.9 from 52.5. That's something that is going to get some attention at the Fed, a little bit at least. And then inventories have suddenly become a deal because we had no inventory accumulation in the fourth quarter, and they fall 45.9. So that should imply that we see some strength ahead. Now, you asked me, my first impression is, call me at 12:01 tomorrow, AM, because if the tariffs go away, then this becomes a lot more important.
Right.
If the tariffs go on, then all the news this week, including jobs on Friday, are going to be overshadowed by all of that.
How are investors, economists reading through these numbers to account for what potential impact the tariffs might have?
Well, you can't take a lot out of the impact on the tariffs except to say, okay, manufacturing is better, new orders are up, but maybe then they're going to change. Now, new export orders rose to 52.4 from 50, which would be good news. But then if Canada's tariffing and Mexico's tariffing our products, then obviously people are going to change their minds and they're going to cancel some of those orders and they'll be looking elsewhere. So this is all the uncertainty that's affecting the markets right now because of this. Even if we have some good numbers, we can't say it's definitely good news.
I have to say I'm very impressed above everything how many tenses you've given tariffs over the course of the last 24 hours. Tariffing. Michael McKee, we thank you so much for your analysis. That is Bloomberg's Michael McKee. And joining us now, Sarah Wolfe, Morgan Stanley Wealth Management Senior Economist. Tariffing. If we think through the potential impacts here, how do you read through the data?
I think that there's going to be some serious impact on U.S. economic activity, and it's not just going to be isolated to Mexico and Canada. We need to think alone, what does the stronger dollar mean for U.S. manufacturing? What is it going to mean for the ability for the U.S. to onshore? Michael McKee just said it earlier, right? Like the PMI numbers are looking better, but if we see tariffs, none of this is really going to matter. Fiscal is going to dominate and really change the economic outlook. It also matters a lot for what the Fed's going to be able to do. We already saw a bit more of a hawkish Fed last week, and then we got really strong GDP data. The job numbers are looking pretty good. And so Powell, who's already in a hurry, not in a hurry to cut interest rates, is going to be put off a little bit more by the upside risk to inflation in the near term from these tariffs.
And I mean, Sonali has brought this point up a couple of times over the past hour, and I think it's an important one because there's the first order tariffs, of course, what we're doing when it comes to Canada and Mexico and China, but retaliatory tariffs. I mean, how do you even begin to model that, or can you not really start until we get past a minute past midnight tonight?
Yeah, so I mean, of course, we're modeling it all out just so we could understand all the implications if the tariffs come on. But the reality is, of course, for Canada and for Mexico, these tariffs and retaliatory tariffs are going to hurt their economies most, right? U.S. trade is about 30% of Mexico's GDP. It's about 8% of Canada's GDP. It's a much smaller sliver for the U.S. But there's certain industries in the U.S. that are overexposed to these two economies. So if we have retaliatory tariffs, we need to think about the auto manufacturing manufacturers up north in Detroit, highly integrated with Canada. I was listening to something this morning that said that when a car is being manufactured, the parts are crossing the border 10 times before we have the final product. And so this is really going to start to impact certain industries. Electricity is going to be one in the Pacific Northwest, energy, automotive. And so retaliatory tariffs are not only going to, really hurt these other two economies, but I think that they're going to start to feed through into higher prices and really start to weaken economic activity in certain industries in the U.S.
Perhaps first-order effects are already being felt in markets. You're looking at an S&P 500 down 1.8% already after a 1% sell-off last week. Industries, you're seeing it in the movement of stocks in the auto sector and the energy sector. But if prices were to go up, a lot of investors expecting inflation on the heels of these tariffs and potentially retaliatory tariffs. What is the read-through effect? How do you kind of gauge the tentacles that this would have throughout the broader economy?
Well, I think just from a rates perspective, this is going to cause, and it already has a little bit this morning, a flattening in the yield curve. If we look at the near-term effect, it's going to make the Fed a little bit more hawkish, a little bit more uncertain with rate cuts, at least over the next 6 months. And so that's been pushing up something like the 2-year higher. But when we look further out on the curve, we're seeing that, the 10-year has come down a little bit because there's this prospect of weaker growth over the medium and longer run because of these tariffs. And so longer dated treasuries are a better place to hide in this type of scenario. And so one of the recommendations we have is to make sure that you're not putting any type of steepening trade on. In terms of what this means for the economy, we have to look at the consumer and the housing sector, which have started to recover off of lower interest rates and off of some of the easier financial conditions we had in the first half of 2024. Durable goods expenditures have started to rebound. Housing activity started to pick back up. Now that we're getting this retightening in financial conditions because of these Trump policies, so think stronger dollar, higher rates, wider credit spreads, this is all going to slow the recovery in the interest-sensitive components of the economy. And so we could see that housing activity starts to slow down again. We already saw that a bit in the fourth quarter, and consumer spending get hit as well.
And I mean, probably the most surprising part of this past weekend to me was that we heard President Trump say last night that actually the Federal Reserve was right to pause its rate cutting path in its decision last week. I don't think that was on anyone's bingo card. But I mean, like you said, Sarah, you're modeling out every scenario here. And to that point, are you modeling out the possibility that maybe this Fed will actually have to raise rates if we do see sustained tariffs at these levels?
To me, the prospect of raising rates is really off the table, because even though tariffs are more of a price level increase, right, they're inflationary in the near term and not over the longer run, you also need to think about the hit to growth, right? Higher interest rates are not going to fight tariff pricing. It's not interest rate sensitive. And so from the Fed's perspective, even though they may feel like they can't cut rates as much in the first half of this year, they still might end up having to cut rates more later in 2025 and into 2026 because of the growth effect. Because now that prices are a lot higher for consumers, they're going to have to pull back their demand, and it's going to hit the real side of the economy. It's going to hurt U.S. businesses as well. And so I really think from that perspective, it's going to be keeping hikes off the table, even though it's taking some of those cuts off over the near term.
Sarah, we thank you so much. That is Sarah Wolfe of Morgan Stanley Wealth Management. Just an incredible day of trading here as investors start to absorb what these tariffs could mean. Now, hedge funds sold U.S. stocks ahead of this tariff threat. Positioning data from Goldman Sachs shows that the move was mainly driven by short selling. Natalia Nizevich is here with more.
Hi, Sonali. So we do see that hedge funds have been actually selling U.S. stocks for 5 straight weeks. As for this last week move, 2 things stand out. So when it comes to sectors, energy, we see an increased short selling activity in this sector, and industrial. So this sector has been net sold by the most in 5 months. On the flip side, however, we see that fund managers are buying healthcare stocks, and this is the sector that they have been buying for 3 consecutive weeks. So something to keep an eye on. So, but overall, we can definitely say that at least for now, there is no bullish activity across hedge funds. And what is also interesting is that they did not buy the dip last week, which typically happens during this big sell-off. So potentially there is more to come here.
Yeah, you did see dip buying when it comes to the ETF sector, but hedge funds not exactly taking the bait there. But let's talk about tech, because tech really bearing the brunt of a lot of the selling pressure today. When we take a look at the options market, what is the positioning showing there?
Right. So when we look at the positioning across options traders, we are keeping an eye on SMH. This is the ETF, which tracks semiconductor stocks. Now we see that protection against the potential downside 10% move versus 10% move up has jumped to the highest level since September. And of course, we are watching NVIDIA. So one interesting move happened last week. Overall, open interest in options, both put and call options, jumped by 1 million contracts last week. Now it is hovering somewhere at around 8 million contracts. And this is very actually rarely when we see such a huge volume of options in NVIDIA. And the chart below that shows volatility for NVIDIA. We now see that it's hovering at the highest level in a couple years. We saw also a lot of bearish activity. So we saw put options being bought by options traders last week at a strike price of 118. NVIDIA was 122 last week. Now it's trading at around $115. So definitely someone has already made a lot of money. So for now, again, positioning is very cautious.
Natalia, thank you so much for looking under the hood. That is Natalia Nizevich. Now coming up, Wall Street is weighing the impact of Trump's tariffs. We're going to break it all down for you across markets. Stick with us. This is Bloomberg.
All right, let's get a check on these markets because volume off the charts right now. You take a look at the S&P 500 trading volume, currently 36% above the 20-day average, and it's to the downside. The S&P 500, you have losses accelerating right now, down about 1.8% on the big benchmark there. The NASDAQ 100, though, is where you're seeing a lot of the pain. The big tech names down about 2% right now. And then you take a look at the bond market. Actually, it was very quiet this morning, but now you have maybe a haven bid coming into the long end of the Treasury yield with your 10-year currently off by about 6 basis points. We are below 4.5%. But let's get back to these tariffs because Wall Street weighing in. You have Goldman strategists saying that there's a risk of a 5% slump in U.S. stocks because of the hit to corporate earnings. And then on the other hand, you have RBC Capital Markets putting that range at 5 to 10%. Joining us now on the impact is Bloomberg's Jess Menton, and it really feels like you're seeing this across the board. But if you drill down to the sector level, let's talk about the autos.
That's right. And especially even if you just point out what the VIX is doing, it's still below 20 right now. So typically if you see it below that, that's more risk that would be in the market, more volatility. But despite everything going on today, but specifically when you're thinking about under the hood and when it comes to those sectors, automakers in particular, especially when you're thinking about Stellantis as well as Volkswagen, because they have a lot of manufacturing plants in Canada as well as Mexico. Stellantis has already hinted at potentially moving some of those plants from Mexico into the U.S. or elsewhere because of what happens. Obviously, it remains to be seen when we go kind of to the 11th hour deadline for once we get closer to Tuesday, what that means. But that is getting pressure there, as well as when you're thinking about what's happening in energy, especially because of just the dynamic between Canada and the U.S., as well as chip makers, because they were already, as we know, under pressure because of what was going on with DeepSeek last week.
Well, let's go down to the chip makers in particular here, because if you look in the Philadelphia Semiconductor Index, you don't see a single stock in the green today.
That's right.
In fact, you're seeing a pretty brutal movement here. NVIDIA is leading the entire index lower by the tune of more than 5%. But even Global Foundries, right, still down 0.5%. The whole index down 2.7%.
Broadcom, Applied Materials also down pretty significantly. Also, Goldman Sachs has a basket of non-profitable tech. So that basket's down even more so. So the reason I pointed out, because it's down over more than 3%, those are more highly indebted companies and also younger companies that are trying to raise funding. So you're seeing that pressured even more so than other corners of tech right now.
And we've been looking for a haven all morning, and it seems like we're going to find it in chicken. And specifically, when it comes to Tyson, a little bit of good news amid this sea of red that we're talking about.
I wanted to point out Tyson Foods because a lot of these metrics, as you know, ladies, when you're thinking about earnings, because right now this week we'll have more than around 20% of the market cap for the S&P 500 reporting. So not as much as what we would have seen last week, but we still have some other tech giants this week. But specifically Tyson, because what it means for the inflation aspect, and especially when it comes to chicken prices, they saw more easing there. So offset some of the slowing slowing sales they saw in beef. But actually, if you're looking at stock, gave up some of its gains earlier this morning when it was higher, but it's out about 1% higher. But even in the last 12 months, kind of went nowhere, only about 1% higher over the last 12 months. But nonetheless, seeing some bright spots there on the inflation story.
Maybe a bull market in chicken around the world with Jess Menton. It's great to see you. That is our equities reporter, Jess Menton. Now, still ahead, some breaking news this morning, and that is Vanguard with its biggest ever fee cut. We'll bring you the latest out of the asset management industry next. This is Bloomberg. Well, big news in the asset management industry today, and that is Vanguard cutting fees for dozens of its mutual funds and ETFs, its biggest ever fee cut. As a result, the average asset-weighted fee is now just 7 basis points across its $10 trillion in AUM. That compares to 44 basis points for the industry overall. Let's break it down with Eric Balchunas. He is Bloomberg Intelligence Senior ETF Analyst, joining us now. 7 basis points, Eric. That's a showstopper.
Yeah, and let's put that into perspective. And this is what I call the scariest chart on Wall Street. Is if you take the 7 bips, multiply by their assets around 10 trillion, you get $7 billion a year in revenue. Mm-hmm. So that makes up about 5% of all of the fund industry's revenue. Yet they make up about 28% of the assets.
Yeah.
Think about that. 28% of the assets, 5% of the revenue. That is a scary chart because the money's going down to the 5%. So what Vanguard does is they sort of set the table with these cheap fees. In my view, they create the terror dome that I speak of a lot. Then everybody else has to kind of like deal.
It's not a place necessarily to get rich unless you have just huge scale.
Well, also, by the way, we should just say, congrats on the scoop.
Thank you.
Great one.
Yeah, where do you find the time, by the way?
Yeah.
What kind of coffee you
This
have?
is my hobby.
Maybe
actually.
for both of you, I mean, how does this compare to what you're seeing with the other giants like BlackRock?
Well, it really is sort of just another step in this never-ending fee war. Vanguard basically sets the tone, and then everyone else has to respond.
But BlackRock is the fastest and most hardcore responder. They're fearless, and that's why they can go toe-to-toe in the flow race. Everyone else, it just takes them a little longer to get the courage and the gumption to cut their fees. BlackRock is probably the best example. About 4 years ago, Vanguard launched their muni bond ETF, VTEB. MUB was number 1 at 25 bips. VTEB was 7. MUB cut from 25 to 7 in 1 day, or to 9, whatever. And it was the top ETF in that category. That's how you compete with Vanguard. You have to do self-cannibalization before you want to. And that is how, again, Vanguard does this because they want it to be this way. Everyone else does it because they have to. And that is why we call it the Vanguard effect.
Right.
And what's interesting about this fee cut, VXUS, the international, went from 7 to 5 or something. Mm-hmm. It's still not the cheapest. I think iShares and Schwab and Spider all have cheaper ones in the international space.
Yeah.
That's interesting. That's the Vanguard effect outrunning Vanguard. That is what has been unleashed here. So sometimes you find people Vanguarding out, even in a category they are not in. The Bitcoin ETFs are a good example.
Yeah. Well, I mean, just the economics of this industry are brutal. I want to talk specifically about fixed income because these fee cuts are across the board. They're across asset classes. But Vanguard is specifically really emphasizing fixed income here. I'm not sure if you caught it, but they had this 10-year outlook that came out a few months ago. They actually see fixed income outperforming equities over the next decade or so. I spoke to CEO Salim Ramji. He said that they haven't made that sort of 10-year ahead outlook since 2000. So talk to us about sort of the competitive landscape when it comes to active management in these fund wrappers.
Yeah, first of all, that call, I get that call. It's a nice contrary call. It's hard to believe, though. But
yeah.
I'll believe it when I see it. Now, the fixed income, they are the biggest bond manager in the world. They have more assets than BlackRock, PIMCO. They dominate already. So for them to dominate more, they're going to end up owning the whole bond market soon. They really want to push the active fixed income. That's where they see growth. They were a little late. PIMCO and JP Morgan came early. In fact, JP Morgan pulled a Vanguard with JPST. So I think Vanguard saw the active fixed income category in particular, someplace they could come. And Ramji in particular, I think that's where he's making his mark.
Yeah.
Also, 2 quick things on Ramji. In the press release, he mentions Bogle in the second paragraph. You never saw that with the last CEO. That's good. Bogle is the reason all this happens. Who else would set up a company where all the profits go to the investors? It doesn't make sense. The other thing is Ramji mentioned we took care of technology first. And that's something, if Vanguard has an Achilles heel, it's the customer service and the tech. So for him to say, we spent some money on tech before we did the cuts, I think that was smart.
Yeah, and I mean, as their first external hire, first CEO, it's important that he invoke Bogle there. I will say, to your point, that you don't buy the call. Ramji did say to me that even if we're wrong on that call and equities outperform fixed income, people's portfolios are still out of balance. They need more bonds. They're too overweight stocks, but we'll have to see how that one plays out. That is Eric Balchunas, of course, of Bloomberg Intelligence, also my co-host on ETF IQ. That's coming up at noon today. And on Thursday at 11 a.m. New York time, an exclusive interview with Vanguard CEO Salim Ramji. Now, let's take a look at markets here, and I think we have some breaking news to contend with.
Yeah, absolutely. We're looking at Mexico's Claudia Sheinbaum speaking, and she says that the tariffs are going to be delayed for a month. We are still, of course, waiting to hear from President Trump as well, but you're watching world leaders really going up to the minute here to try to work out these tariff plans before midnight tonight. She said that she had a good call, good in quotes, with President Trump that led to some accords. We will bring you more details as we get them. They are moving markets off of session lows. The S&P 500 still down on the day, but less than it was a little earlier.
You're also seeing the follow through in the currency market in particular. You take a look at dollar peso right now. The peso erasing its losses against the dollar. If you pull up USD peso right now, you can see that intraday move. But still, relative to the strength we've seen in the dollar against the peso, maybe traders waiting for a little bit more follow through here before they make any big moves. But that currency pair, at least, back to unchanged. Now, coming up, we'll discuss Trump's tariffs with Joe Lavorgna. He is former White House economist under Donald Trump. Don't go anywhere. This is Bloomberg. We do have some breaking news on the tariff front. This coming from Mexico's Sheinbaum, saying that she had a good call with Donald Trump that led to some accords. The red headline here is that Sheinbaum saying that tariffs are delayed for a month. Remember, of course, they were supposed to go into effect at 12:01 a.m. on Tuesday. But now you have Sheinbaum saying that these tariffs will be delayed for a month, that Mexico and the U.S. are going to work on security and trade. The U.S. is to work on preventing arms trafficking, and Mexico to strengthen the northern border with the National Guard. You can see that the Mexican peso right now erasing losses on these comments, and we have coverage across the continent right now. Carolina Milan in Mexico City, Bloomberg's Tyler Kendall joining us from outside the White House, as well as Laura Dhillon-Kane in Ottawa. And Carolina, of course, I want to start with you and these breaking headlines right now. So Sheinbaum saying that tariffs are delayed for a month. Give us a little bit more color on what happened on this call.
So just minutes ago, we saw this post in X from President Claudia Sheinbaum, who said that, like you just mentioned, the call with President Donald Trump was very positive and outlined a series of agreements that the two leaders reached to stave off these tariffs for another month. We know that migration and that fentanyl trafficking have been the two top topics that President Trump had mentioned as the key points to deal with to work on the tariffs. And so it seems that those were the main topics that were discussed on the call. Sheinbaum is due to speak in just a couple of minutes and to give an address to the whole population. So we will surely know more details then. But it seems that the bottom line is that the cool-headed approach that Sheinbaum had been discussing in the last few weeks has prevailed, and that they have opened a way for there to be more conversations about these tariffs and whether enough measures are being taken to appease Trump's demands.
Our thanks to Bloomberg's Mexico Bureau Chief Carolina Milan. We thank you for your latest reporting. Of course, this is a live situation still. We're going to now bring in Tyler Kendall in Washington. From where you sit, of course, a lot of calls going on with world leaders and the White House. What's the latest?
Yeah, Sonali. So I actually had the chance to catch up with Kevin Hassett earlier today, the director of the NEC, and I pressed him on what exactly the White House is looking for when it comes to benchmarks of progress for Mexico and Canada in order to ease these tariffs. He said he didn't want to get ahead of these calls that President Trump is having with his respective counterparts in Mexico and Canada. So we'll have to see, as this is a developing situation, what exactly President Trump was aiming for and what exactly is on the table when it comes to a negotiation. But one thing that Kevin Hassett did want to make clear to me is that the White House's messaging around this is that this is a trade war, that this is not a trade war, but rather a war on immigration and illegal drugs. That kind of gives us some more of a sense on how the White House and the administration is trying to frame its argument around using emergency powers. But Sonali and Katie, just quickly, one other big question that the White House is dealing with today is what this will mean for consumer prices, particularly after President Trump floated that there could be a little pain. I did ask Kevin Hassett this. He says that he disagrees with some economists who say that there will be a spike in inflation. Instead, what he calls supply shocks will help bring prices down. It appears evident that this White House is banking on a boost in domestic manufacturing, but not everybody agrees with that. According to the National Association of Manufacturers, which represents about 14,000 groups in the U.S., they say that these tariffs, if implemented, would cause widespread shocks to their members.
Yeah, certainly a lot of investors also wondering about the inflationary impacts here as well. Tyler Kendall in D.C., thank you. Let's go up north now and bring in Bloomberg's Ottawa Bureau Chief Laura Dhillon-Kane. And when it comes to the phone calls that are happening today, President Trump said that he's already spoke to Canada's Justin Trudeau. We'll be speaking with him again at 3 p.m. What happened this morning and how are we expecting this afternoon to go?
Well, I will say the news that tariffs are being delayed on Mexico by a month took us by surprise. We are checking with sources as to whether Canada received the same message, but we have not heard that at this point as it relates to the tariffs on Canada. Canada is still trying to understand what Donald Trump wants from it. We unveiled a $1.3 billion, that's in Canadian dollars, border plan to strengthen our border, even though only 1% of the fentanyl seized in the U.S. actually came from Canada last year. So Canada is trying to understand how it actually fits in this emergency declaration and what Donald Trump is looking for from it. He's also raised the trade deficits as a concern. He's also raised Canada's low defense spending. And he's also floated, many times that he wants Canada to become the 51st state. So Canada is trying to understand, and Trudeau is trying to understand what he can actually do to stop Donald Trump from following through on these threats. And Canada has already unveiled a very comprehensive retaliation package covering about $107 billion worth of U.S.-made goods, including Kentucky bourbon, Florida orange juice, and then later on looking at things like steel, aluminum, and cars. So Canada has already promised to hit back very hard if Trump follows through on this threat at 12:01 a.m. tomorrow morning. And it continues, in the final moments, with the 3 p.m. call booked between Trudeau and Trump to try and stop this from happening.
Bloomberg's Ottawa Bureau Chief Laura Dhillon-Kane, and Mexico's president is also speaking right now. You can see an image right now of Claudia Sheinbaum. We're going to continue to monitor that for more headlines. And joining us now for more, Joseph Lavorgna, SMBC Nikko Securities America chief U.S. economist and former chief economist for the White House National Economic Council under the former Trump administration. I want to start where Laura left off. This whole idea that you could see retaliatory tariffs. That is something that would impact export pricing. It would impact American manufacturers, would it not? I mean, at that point, how do you start to gauge what the ripple effects of this tariff policy are going to be?
The U.S. we're operating from a much stronger position. So in the case of Mexico, 83% of their exports are to the U.S. It's about a third of their GDP. I mean, a third of their exports are 82% go to the U.S. Exports are 33% of Mexico's GDP, so they would lose about 2% is the U.S. share of Mexican GDP, the exports too. So when you look at the numbers, they're massive. So, and that's basically the same thing for Canada. So the administration is operating with a much stronger position. So the ability of our trading partners to retaliate is quite low. And if the comments coming out of Mexico are correct, that's evidence as such that we're in a bargaining position. We're in a much stronger position. We're the big consumer. We're the big player.
Yeah, that does seem to be the consensus here, that the Trump administration has the leverage. But there is this line of thinking out there that, this could send some of our trading partners into China's arms, for example. You take a look at what Larry Summers has been saying. This from a post on Blue Sky, not on X, of course, saying that Trump's tariffs are a bully strategy. Bullying doesn't win over time on the playground or in the international arena. This self-inflicted supply shock is a strategic gift to Xi Jinping. What do you make of that argument?
Larry's got an axe to grind, as many of us do, but certainly he does. And President Trump is a bully for U.S. interests. And there's no way you could look at China and see some of the things they've done where trade has been very unfair. They flaunt environmental rules, child labor rules. This isn't like, Ricardian equivalence you're going to learn in Larry Summers' Macro 101 class. Totally different situation. And I do think that some countries certainly respect a more aggressive, tough approach. And the fact that right now we're dealing with our trading partners in such a way is going to set the table for maximal leverage against China. And at that point, when it comes, it won't look as aggressive, but in fact it will, because things need to change.
I hear what you're saying about axes and grinding them, and of course, Larry Summers' personal position here. But I mean, when it comes to the argument that, a trading giant such as China could benefit from this alienation of Canada and Mexico, I mean, is that something that you could see playing out?
No, because the way that I see President Trump's tariffs and what he has said is there's going to be two tiers of tariffs. So if anything, if production moves out of China, it will go to lower tariff jurisdictions. It might be Cambodia, it might be Vietnam. High value added might go to Japan. Companies will be incentivized to come to the U.S. because ideally there'll be lower corporate tax rates, more abundant energy, deregulation that makes it very pro-business. As I said, the U.S. and Mexico are so inextricably linked. I highly doubt they're going to go to China, and the same thing with Canada. And again, the fact that President Sheinbaum has already said, if it's correct that they've delayed the tariffs, means to me that in the negotiations, it's so far going in the U.S.'s direction.
Right. Going back to the negotiation point that you've been making here is what you're also saying, that these tariffs don't need to take effect. A lot of investors are looking to see whether that 12 p.m. deadline will even be met in terms of
12 a.m.
12 a.m. Right. And so overnight, right? I mean, it's very close from now. Do you think they'll hit deals that are getting over the line in terms of protecting against these tariffs actually taking place?
That I don't know. As Kevin Hassett said, he doesn't want to presuppose anything and get in front of negotiations. Certainly, I don't know on that score. But what I can tell you is it seems to me the tariffs serve three purposes. One is they're going to raise revenue. So we're going to have tariffs on some level. Two, they're an incentive to get countries to the bargaining table, which clearly is the case we have right now. And then three, as I was alluding to, you need tariffs as a way to reindustrialize and protect U.S. industry, especially with technology. Yes, a lot of low value-added manufacturing jobs are highly unlikely to come back to the U.S., but that's not what President Trump is targeting. He's targeting high value-added jobs. And with AI and technology investment and things of that sort, that's what you want to try to protect. And tariffs are an incentive to protect those nascent industries. And by the way, you can go back and look at textbooks. Tariffs all of a sudden now became a political tool. That was never the case. Tariffs are a tax, and they can be used productively. And in this case, if they do raise revenue and you get lower corporate tax rates and lower marginal tax rates, that to me is a wonderful trade-off. It seems like many of the economists, the ones a little bit left of center, have kind of forgotten all that.
I hear what you're saying about negotiation, but on the other hand, I want to pull up ECTR on the Bloomberg terminal here, because this does show you by the numbers what the trade deficits look like. And if you sort it by the deficit in particular, you see just how deep the deficit is with China, Mexico, and Canada in that order. Now, if we have all the negotiating leverage, but the deficit is still that large for those three countries, then how do you know that there's not going to be a more negative effect on American businesses? The S&P 500 today, isn't that speaking for itself?
It was up 3% in June. I mean, come on. We've had a pretty big run in anticipation of President Trump winning. Look, on the deficits are important, but that's kind of like the tail. The dog is the economy, and what President Trump wants is 3% GDP growth, 3% plus, which is very doable. We had 2.8 just before the pandemic, and productivity, which began accelerating under President Trump, has continued. We want low and stable prices, and we want a healthy stock market, which will be higher. Where the deficit is remains to be seen, but it seems to me that the overall broad economic environment with also low unemployment is what the president wants to achieve. He has the good data from the first administration. So if you're looking what the blueprint is, that seems to be it. We'll see if he's successful. Clearly, there are execution risks in doing so many things at once. What I've seen so far makes me optimistic.
I want to talk a little bit more about the market. As you mentioned, of course, we've had this pretty fantastic run up in the S&P 500 since Trump's victory in November. But there's this notion out there that the so-called Trump put, this idea that Trump cares about the market and will act to sort of cushion the market when we see declines. Maybe the strike price on that is a little bit lower. So you have experience in the Trump White House. Of course, you were a member of the first Trump administration. Do you think that the Trump put exists? And if so, has it changed at all?
It's a negotiation, so the president is going to give a little to get a little bit, and ideally make a deal that is a net benefit to the U.S. But your point runs exactly counter to people like Larry Summers, which is like, okay, this is the scorched earth policy, which is going to have no net benefit. No, it's a negotiation. It's a tough negotiation. We see it all the time in professional sports. We see it in business. It's a tough negotiation, and the president, I think, is pretty good at this. He's predictably unpredictable, which is a phenomenal negotiation technique. So let's see where it goes. Let's see where it plays out. But it seems to me what little we've seen to this point, I think, is effective, and where it goes with China, which to me is really the real big strategic issue, which, by the way, under the former administration, they kept the prior administration's tariffs in place. They had voluntary restraints on technology exports. So, I mean, I think President Trump is onto something here.
All right, Joe, it's great to get some time with you. That, of course, is Joseph Lavorgna of SMBC Nikko Securities. And you can follow Mexican President Claudia Sheinbaum's remarks on LiveGo on your terminals. And as she's been speaking, you've seen the S&P 500 really claw back some of its losses on hopes that maybe tariffs will be delayed for a month. You can see that in the S&P 500 now down about 0.7%. The Nasdaq 100 as well now down about 0.8%. It was down 2% just in the past hour or so, but clearly those losses coming back. The dollar too giving up some of its gains. And coming up, more on tariffs and tourism. We'll talk about how Trump's policies could hit the global travel business with James Ferrara of InteleTravel. That conversation up next. This is Bloomberg. All right, we are watching the evolution of these tariff threats on Canada and Mexico and China. Of course, we know that Mexico's Claudia Sheinbaum and President Donald Trump have recently gotten off the phone. Sheinbaum saying that tariffs have been delayed for a month. We know, of course, that Trump will speak again to Justin Trudeau at 3 p.m. today, so maybe some more headlines around there. And of course, as we wait to see how this plays out, we know that these tariffs could have far-reaching consequences for the global travel industry as well. And here with his reading on the early trade war impact, I'm pleased to say we have James Ferrara. He is the co-founder and president of travel advisory site InteleTravel. So we've been talking, James, about the auto industry. We've been talking about booze. We've been talking about food as well. When it comes to travel, what do you think the potential read-through could be should we see sustained tariffs at these levels?
Good morning, and thanks for having me. As the tariffs are proposed now, they affect goods and services, and I really don't see a direct effect on travel. If I were sitting in Canada right now, owning a Canadian business or earning an income in Canada, I might have a very different perspective, right? It could affect my available travel dollars. But this is all a grand negotiation at the moment, and we really don't know where it's going to wind up. The one concern I have for American travelers going on holidays and vacations is if the retaliatory actions of some of these countries move into things like requiring visas where visas were not required before, sort of punitive things like that, adding a departure tax or an arrival tax in a country, then we could be looking at a direct effect on travel. Also, I suppose if your new car is going to cost you $3,000 more because it's being made or parts are being made in Canada, you might choose to skip one of your holidays this year. But I really think that's very far down the line, and we have to see where these negotiations go.
You know, in the nearer term, before you worry about consumer cost pressures, the reality is, too, there's major currency fluctuations across the world as well. When you look at Canada, when you look at the peso as well, in Mexico, and of course in other parts of the world for other reasons that are not directly linked to tariffs. How are those currency fluctuations, if at all, impacting the way consumers decide their next destination?
Well, that does play a role for consumers. We saw that in recent years. Everyone flocked to Europe when the euro was down significantly historically. So again, the way it's currently playing out, it looks like the currency fluctuations are in country, like the drop in the peso, although it has recovered this morning. And that actually attracts American travelers, right? We get more for our money. So I put that in the good column.
Well, when it comes to the bad column, I do want to talk about the sort of hit to consumer sentiment, inflationary pressures we've been talking about this morning with our economists and our reporters. And when it comes to travel, maybe besides the political pressures and maybe people from Canada don't want to travel to the U.S. right now, what do you think the effect of higher prices could have on the segment of travel that you operate in?
I don't see a clear path to these higher prices right now, but consumer confidence, something you mentioned, is very, very important when it comes to travel. And uncertainty and political instability affects traveler consumer confidence greatly. So there's an area that we have to watch.
James Ferrara of InteleTravel, we thank you so much for joining us today. Of course, all eyes on the consumer as well as investors, as business owners weigh the impact of Trump's tariff policy. Stick with us. More markets ahead. This is Bloomberg.
All right, welcome back to Open Interest. You can see the S&P 500 clawing its way back from the worst losses of the session. We were down about 1.5% at one point, now down about 0.8% after President Claudia Sheinbaum of Mexico said that U.S. tariffs against Mexico will be delayed for a month. President Donald Trump followed up and confirmed that on Truth Social, and that's giving some lift to this market. Of course, we know that, Mexico and the U.S. are on speaking terms right now, have seemed to work out a one-month deal. The question mark now is Canada. President Trump and President Justin Trudeau will speak at 3 p.m. today. It's going to be interesting to see if Trudeau can also secure a delay here.
Yeah, absolutely. You have President Trump saying on Truth Social that there was a very friendly conversation where Claudia Sheinbaum agreed to immediately supply 10,000 Mexican soldiers on the border separating Mexico and the U.S. So this would delay those tariffs at least for a month. He also said that Scott Bessent, Marco Rubio, and Howard Lutnick, this is the holy trinity here.
Oh, boy.
These are the people who are dealing with the negotiations at large, and it's interesting to see his team come together. Now, as you and I have been talking about this morning, Canada's response so far has threatened retaliatory tariffs. You already have Ontario canceling a Starlink deal and barring U.S. firms from contracts. So it's not coming in as friendly, at least, into that conversation.
Absolutely. It's going to be really fascinating to see what gets done, what happens before a minute past midnight tonight when those tariffs were set to go into effect. Shaping up
Cinderella
to be,
story.
I know. Shaping up to be a really interesting market, of course. A lot can happen between now and 4 p.m. We'll see where it all settles. But coming up tomorrow on Open Interest, really looking forward to this lineup. We have Mike Wilson of Morgan Stanley, Katrina Dudley of Franklin Templeton, and the CEO of the parent company of Best Western Hotels. That's coming up tomorrow on Bloomberg Open Interest. Much more markets conversations coming up on Bloomberg Television. This is Bloomberg.